Passive Pockets is presented by Equity Trust. Hello, passive investors. Welcome to Passive Pockets, the passive real estate investing show brought to you by Equity Trust. We're your hosts, Jim Pfeiffer and Paul Shannon.
Today, we're talking about what's changed in multifamily since the turbulence of 2022 and how to position yourself in the current market environment.
Our guest today is John Dr. Doom Drachman, who earned that moniker back in 2022 for painting a troubling picture of what was on the horizon. He's here to share what he saw back then, what he's seeing now, and how passive investors can adapt to today's conditions.
Let's jump right in and hear John's take on why he got the nickname, where the market stands, and what lies ahead for investors.
Awesome. Thank you, Paul. I am super excited. It's like we're having a Bond villain with the name Dr. Doom. So not saying you're a villain, John, but can you just kind of tell us where the nickname came from and what was it in 2022 that what indicators did you notice that kind of told you something was coming?
First off, great being here with both Paul and Jim. I really appreciate the opportunity. So my firm that I co-founded called Waterford Property Company, we're based here in Southern California. So we focus on multifamily assets. We do a lot in the affordable and workforce housing space. We've probably done since 2014, almost $3 billion worth of transactions. And in 2022, the market was a little bit slower with rising interest rates. And, that was just sort of that period of time, specifically sort of the summer of kind of the early summer of 2022, where, things were slower. And, we were trying to figure out sort of how the cycle was going to go, where opportunities would be. We saw a lot of shift in the landscape. And I had recognized the fact that back in 2020 and specifically 2021, we were really active acquiring existing multifamily projects using tax-exempt bond financing in California for some workforce housing strategies and leveraging the low interest rate environment to lock in really long-term low interest rate debt or bond financing, I would say. But I had been kind of keeping track of where the multifamily markets were going. And obviously, you were seeing just an explosion of deals throughout these Sunbelt markets. And a lot of them I saw were by sort of newer, I would say less experienced operating groups or operating partners. So I was always sort of curious, like how these deals were getting structured. We had looked at potentially expanding out to Arizona as a firm in 2018 and 2019. And back then, we couldn't necessarily make sense of how to acquire deals. And we had to be really aggressive to buy these sort of value add projects in those markets. And so we were sort of like, we could never make sense of it. And so I just started doing a bunch of research and looking at, how those deals were getting done. And transparently, the impetus was I had a good friend of mine. I've told this story a couple of times, but I had a good friend of mine. We were literally playing golf and he is in the development business. And he was telling me how he was developing in Las Vegas. And he shared with me these comps from deals that were done sort of the second half of 2021 and the first half of 2022. And he goes, look at these people buying these 70s and 80s and 90s vintage products in Las Vegas for sub 3 caps, sub 4 caps, really aggressive pricing. I'm going to build in Las Vegas because if I can build for almost the same price as what they're paying for on a per unit basis for older vintage assets, it makes all the sense in the world. I was like, how could people be paying those prices? And if you go online, if you do research, you can figure out that a lot of these deals were getting done through really aggressive bridge debt that is packaged up and sold into these sort of what they call CLO products. So collateralized loan obligations. A lot of that data is public. And so I started digging into it and I got a hold of a couple loan documents for some of these deals. And really, I would say kind of the loan summaries. And I was like, okay, this is how this is getting done. This is the GFC all over again. This is 80% financing, hyper aggressive floating rate debt on deals that when something happens, these deals could really struggle. I saw him like 3 weeks later. I said, hey, I figured this out. These deals don't make any sense. You shouldn't be basing your development thesis on these. And I think you're going to be in a bad spot if you go do these development deals. And he said, you sound like Dr. Doom. And that was Nouriel Roubini. He was a very famous person, economist, I think from NYU during the GFC. And I said, no, I'm serious about this. And I joked with him. I said, I'm going to post on LinkedIn. I'm going to call myself Dr. Doom, and I'm right on this. He's like, no, you're not. Well, so then I did. And that kind of, took off really quickly. And kind of here we were. And it was really once I got a hold of the sort of the loan summaries and figured out how these deals were getting financed, it just brought me back to the GFC and my time then of seeing deals get done with, little equity, very aggressive underwriting, very aggressive assumptions on where rents are going, what construction costs were going to be. And then obviously it was, well, hey, this is floating rate debt and rates are now starting to go up. So your debt costs are going to go up. And I think your NOI targets you're not going to meet, and your debt's going to go up. Well, this is just a recipe for disaster. And that's really what happened. And then you couple that with the amount of new development and new supply that you were seeing in those markets. And to me, it felt like a perfect storm where you were going to see potentially really hard times.
And why did so few people see that? Like there were a couple of others that I know were looking at that, and other people backed off, but some people still went all in. So why did you see it and others didn't?
I jokingly say when it's 2 a.m. in Las Vegas, nobody wants the party to end, right? So everybody goes and says, let's go have another Red Bull vodka and let's keep this party going, right? And nobody wants to recognize what's the consequences of that, right? And so I think when you think about that market, a lot of people were doing well, lenders, operating partners. There were a lot of investors, by the way, who had invested in those deals in 2019 and 2020. They were getting really nice checks from this sort of game that was getting played. And so this is real estate. Like when the market is doing well and things are going well, I don't think people want the party to end, right? And so I think you've seen this across the board. Nobody, we didn't have a vested interest in those markets. We weren't highly invested in those markets. So I didn't really care, right? But if you were invested in those markets, why bring up the problems, right? We have a tendency in our industry to be optimistic and, things were working well. So who wants the party to end?
Hindsight is 2020, but when you think back to that time, the federal funds rate was at 0. Inflation was at about 9% in early 2022. Up to that point, the Federal Reserve was saying that inflation was likely transitory, but it started to show signs of being more structural. And they started telegraphing that rates were going to rise, which interest rates and the FFR aren't directly tied to one another, but you could assume that there would be some interest rates increasing, and that would create some downward pressure on real estate. But that was then, and this is now. So let's talk about where we are today. There was the popular phrase, survive till 25. Most groups did, right? But today, transaction volume is still anemic. What's it going to take for the market to start to pick up and there to be more transactions happening?
What's so unique about this cycle, and so one of the things for any of your listeners, so I've been fortunate where I've taught at USC in their graduate real estate program for the last 9 years. And so I'm very in tune with what, talking to my students about the markets. I think what's so unique is, every cycle is different. And this cycle is really very unique. And part of it is, that's like a hard question to answer, Paul. And what I mean by that is, I think you hear this term commercial real estate. What's it going to take for commercial real estate to now change or, a transaction to increase? Well, now commercial real estate, it's like, well, you've got office buildings that are suffering because of a lack of demand. You've had industrial that has kind of been a belle of the ball. You've got data centers, which people would tell you there is no recession. So I think that's a hard, nuanced question. And what I mean by that is, as you think about multifamily, specifically multifamily, one of the reasons we're in this current situation is because after COVID hit, effectively equity investors on the institutional side could not go into retail, they cannot go into hospitality, they cannot go into office. And there was this period of time of really high liquidity in 2020, 2021, and the first half of 2022. It was sort of risk off and let's go. But you could not invest in those product types. So what happened was a lot of those groups invested into multifamily existing assets or multifamily development. So part of the issue with this cycle on the multifamily side is when you look at some of these markets, we're still dealing with the consequences of that in terms of the amount of new supply that's coming. Now, thankfully, where I was wrong was the amount of absorption specifically towards the end of 2023 and through 2024 has mitigated what could have been even a worse cycle. Because I think if we would have seen absorption go the same levels where it was in 2022, because that was the other thing. 2022, absorption really went negative in many of these markets. So you look at the forward-looking trends with all this new development and new supply coming, it was really dire outlooks. Thankfully, in these Sunbelt markets, absorption has stayed strong. In some ways, that's causing this cycle to take longer to turn. So to answer your question, because if you think about it, if absorption happened what happened in 2009, where absorption cratered in a market like Phoenix, right? Because people literally moved out. I actually think you would have seen the cycle turn faster because things would have gotten worse. And as things would have gotten worse, transactions would have happened faster. The issue with multifamily is that as absorption has stayed positive, it's helped mitigating some of this, but it's just allowing this sort of extend and pretend market to happen. I think you're going to still see little to, maybe an increase over 2024 in transactions, but not in some meaningful amount. Not like what we saw in the GFC, where 2010 happened, which was higher than 2009. And it almost sort of from a transaction volume, it started small, but it kind of doubled every year to by 2014, it was the same as 2007. But realistically, by 2011, 2012, things were starting to move again. And that's because the cycle was so bad. In this case, transparently, we haven't seen a recession. You haven't seen the job loss numbers to really impact multifamily. So if you locked in good debt in 2000 or 2021, why would you sell? Right. And so that's kind of a major issue. It's kind of similar to what we're seeing on the single family for sale side of the business, where there's a lack of transactions. And part of it is because people haven't lost their jobs. People have low interest rate, fixed rate loans. And so they're like, why sell? It's like when I tell my wife, we've got 7 years left on our 10-year IO loan at a very cheap rate. And then she's like, John, maybe. I go, no, we can remodel. No, we can fix the backyard. Right. Like I've got a 3.25% rate. We're not giving that up. So I think it's this combination of factors that are making it challenging. I think we're all optimistic. Everyone is in our industry. And I think we're really optimistic for 2025, but it's going to be tough.
One of the other things you mentioned is, and we haven't seen, is really distress in the market. A lot of people thought there would be this sort of wave of defaults, and in multifamily anyways, we haven't really seen that happen. So do you think as part of the, as you called it, the cycle turning, that sort of cleansing has to happen, the extend and pretend has to end, and we're going to see more distress in the market this year?
I think we will, but again, it'll really be predicated on what happens from an absorption standpoint. If absorption stays strong, I think there'll be less lenders and these bridge lenders, which are more unique to this cycle, will figure out ways to, get creative with how they potentially refinance a loan and kick the can down the road. And you've seen this. We've seen these sort of transactions where lenders go, okay, we're going to restructure this loan, bring in new equity. We don't want to foreclose. And part of it is because we think there's just a bad basis. So I don't know. The other nuance is, when you look at a market like, let's say, Phoenix, for instance, there is so much new supply that a lot of the equity wants to go into that new Class A market. So you're actually seeing operators who were prevalent in these value add structures buying new Class A deals because they're saying, I want to be in that space. I don't want to buy the older vintage deal. And so in these markets that have had a lot of new supply, I think that's playing into it. And so groups don't want to take the loss. They can afford not to on sort of the B and C property. You would anticipate more would come. As I kind of say, like extend and pretend, I don't think it ever really works because when you have a bad basis, like you have a bad basis, you're going to have to figure that out. It's tough to know because I thought for sure we would see more distressed sales and you just really haven't. In some ways too, the investors, it's not the product that they want, right? They don't want that 80s vintage product in Phoenix. They want, the nicer vintage projects where they believe that, rent growth when it comes back will be more likely to come back in that product, where the tenants are gravitating towards. Because again, this is what's so unique compared to the GFC is we're not in a recession. Job numbers are strong, right? There's this whole very nuanced thing that's happening that's very different than the GFC. Very different.
You talked about these, new properties versus a rehab property from the 80s or whatever. Now, in the 20 teens, people were okay with the rehabbed property because it comes out as new. So why are people so cautious, I guess, to go with those older properties that have been rehabbed? They've all been rehabbed, right? So why wouldn't that be just a cheaper way to get into a nice apartment, either as an investor or as a tenant?
I think it's a couple-fold. One, from a tenant-based perspective, I think what you're seeing now, and we've seen this in data, is tenants are really, as we haven't hit a recession, as incomes have grown, the difference is a 2022 vintage apartment, let's say in Phoenix, is dramatically different than a 1985 vintage apartment in Phoenix. A 1998 vintage apartment in Phoenix isn't that different from a 1985. And what I mean by that, when you look at the amenities, when you look at how these new apartments are built, And so many of them are built to these kind of luxury standards. The tenants, they're saying, I'll pay more because the experience and the quality of the experience is so different, right? And I'm talking more the institutional investors, the Blackstones of the world. They're looking at this going, we can charge more rent and we think there'll be more potential growth if we don't hit a recession in those higher quality projects. And long term, if we have a 5 to 10 year outlook, we'd rather be in the higher quality project because we think the demand will be there for that. I think that's the nuance, is that value add plan. You got to remember, coming out of 2010, the GFC, we didn't build a lot of apartments until about really starting in 2014, 2015. And that's really where you saw apartments that started getting built that were highly amenitized, where you have not just a gym that's in the sort of corner basement, right? Where you have a gym that looks like an Equinox, so to speak, right? When you have, I mean, I see these new apartments getting built. I'm going, this is not the apartments I lived in college. This is not the apartments I lived in post-college, right?
Or student housing for that matter.
I mean, that's a perfect example. I went to the University of Arizona for undergrad. And, you look at the student housing around the University of Arizona, which now have these high-rise towers with rooftop pools. I mean, it's crazy, right? So I think that's happened all across multifamily. And so I think there's a belief that if you're going to buy in a market like Phoenix or these markets that have heavy supply, buy high quality assets. And so that's been the change in the investor mindset. And so, and I think you've seen it when you look at rents and you look at occupancy numbers, the older vintage deals have been impacted, right, in these sort of high supply markets. And so I think that whole narrative has shifted on a dime. And to me, the mistake made by a lot of these operators, they weren't studying development trends, right? This is a classic real estate cycle. Real estate's all about supply and demand. Some of these markets, they just got ahead of demand and they're building too much supply. So what does that happen? That means rents can come down. Those people who bought in Las Vegas, what they weren't considering when they bought for a 3.5 cap and they paid $250,000 a unit, when replacement costs were $275,000 a unit, they didn't realize they were creating this, right? They were their own worst enemy. They didn't see that. That was just inexperience. And what happens is developers, especially when equity is saying, oh yeah, we'd love to develop, developers build. And so they built really nice product. And I think now you're seeing the institutional base say, we don't want the older vintage deals. We want the nice newer vintage deals.
So John, if that's true, the institutions don't want older vintage, somewhat obsolete product. Let's take a 1980s vintage product for an example. Maybe it's been through second, third, fourth generation value add. It's been flipped like a hot cake. Does that mean that the value add strategy is dead? I mean, we still need affordable housing in this country. Where does the stock come from if it's not from that vintage product?
I don't think it's necessarily dead. I think it's just that idea that you're going to buy it and flip it within 18 months and play that hot potato game, as you said, Paul. I think that's dead for a while, right? And I think that's not what multifamily ever really was. When I think about multifamily and I think about sort of what multifamily is in the spectrum of real estate, right? I've always felt like multifamily is kind of a boring business, right? Boring's a good business though, where people need housing, and it's a business that should be based on cash flow, and it's a longer term hold. And the sort of the alpha maybe isn't as strong, but if you hold multifamily long term, traditionally, if you look at most people who finance it correctly and hold it long term, it can be a great long term investment because we are undersupplied in housing in the United States. It is a critical need. So I think there's still opportunity with it. I just think it got so hot, so fast, the prices got way out of control that I think it's going to take a while for that to cycle through. But it's not to say you still can't make money owning a 1980s vintage deal in Phoenix, but you have to buy it right. You have to be smart about what your repairs and maintenance are going to be, what your vacancy is going to be, what your rent growth is going to be. And the challenge is, this is where the disconnect is, that value compared to where it traded for previously. I mean, it's so dramatic that people don't want to take that loss yet.
You mentioned the strategy before was you could basically flip these things in 18 months, right? And at Passive Pockets, our community is limited partner investors. Now these investors have endured paused distributions, capital calls, full loss of capital. So can you talk a little bit about where do they go from here, right? We have to get used to, we're not going to be able to double our money in 18 months or 2 years anymore. Where do we put our capital? There's capital on the sidelines and we still have liquidity. Do we put it in multifamily? Do we wait? What's the LP perspective?
If I was a private investor And we traditionally have raised most of our capital from institutional investors, but we have raised money from private investors in the past. It's probably a smaller percentage of our business, but we have. I would always try to look at these things and say, okay, let's say you have money in investments that aren't working out well. I would be looking at myself in the mirror saying, okay, what did I do wrong? You probably did well on some deals and you thought the music would never stop. And you forgot the fact that real estate is a very cyclical business. And that's okay. Some of the mistakes that were made were groups invested with people who were not necessarily fully experienced at operating real estate. What I mean by that, if you think about multifamily, we say in our firm, multifamily are living, breathing assets. We have small cities within our portfolio. So you have to find groups who understand how to operate real estate, which is transparently not a fun, sexy business. Really fun to do development, really fun to do acquisitions, really fun to flip stuff. But you have to really think about investing with people who are okay with the day-to-day grind. I would be hesitant to fully write off real estate because I think that transparently, when I hear people say, oh, I'm never going to invest in real estate again, I go, oh, it means probably it's a good time to invest in real estate, right? Like whenever I hear students, like my students are like, oh, I don't know if I want to be in real estate. I don't think real estate's where it's at anymore. I go, good. I like hearing that because that means less people get out. There's more opportunities because real estate's not going anywhere. I think it's about being smart. I think it's about accepting the losses, recognizing the fact that some of it was maybe your own doing, some of it wasn't, being okay with that, learning from it. And I think specifically if you were going to invest in multifamily, I would think really long and hard about investing with groups where you felt like they were great operators. They had a strong background in operating real estate, and they had more longer term approaches. It was more about cash flow. It wasn't about over leveraging deals, and the interests were aligned correctly. And I think that's how I would look at it.
So when you're looking for operators, again, we're LPs, so we're not institutional investors. You mentioned a couple of things that you think would be good operators, the track record, and that they want to get into the grind. How does an LP really look at that and say, okay, operator A versus operator B, this is the right one to invest with?
The first thing I look at is how many deals did they do in 2022? Because to Paul's point, by 2022, it was clear interest rates were rising, right? It was clear that this game had sort of been up. And look, everybody's going to have projects that they did in 2020 and 2021. They might look back in hindsight and go, oh, I don't know if we wish we had done that. I mean, it's not like our firm is, perfect. No real estate developer or investment group is ever going to be perfect. You're never going to bat 1,000. I think, though, there were groups by especially the summer of 2022 who were still very active. And I look at that as a very much an indication that they didn't know what they were doing. Actually, even worse, they knew what they were doing, but they didn't care, right? And I think I've seen Paul be pretty vocal on LinkedIn back in those periods of time saying, hey, market has shifted. I'm not going to be as active, which can be hard to do, especially when the equity, is coming in. And so I really would ask the question, how many deals did you do in 2022, specifically with floating rate debt? Why would you ever do floating rate debt when interest rates are rising? It's counterintuitive. So if you did that, it was sort of the last people at the dance. My sense is that'll give you a good indication of the groups to avoid. And if you find a group who said, yes, we did deals in 2021, but as soon as we saw interest rates rising, we sort of stepped to the sideline and we realized this was going to be a hard cycle. I think that gives you an indication of what's their thought process. Were they playing it for short term or are they playing this game for the long term? And I think that would help you do that.
Yeah, and I think the analogy there is you're okay going with the guy or gal who maybe is at Vegas at 2 a.m. with the last drink, but the ones who were in 2022 might have been there at 3 or 4 a.m. with the last drink, and that's where you really get into trouble.
That's when it's like you really regret the hangover the next day.
Exactly.
John, I want to shift gears in the conversation a little bit. You're a California guy. A lot of our listeners are focused on the Midwest or the Sun Belt. They just happen to be red states. I don't know if that's coincident or not, but there's sort of this fear of California, or let's, lump in Illinois and some of the other coastal states. There's restrictive landlord laws, there's high taxes, there's inefficient government, there's a lot of other scenarios that make it not as friendly of an investing environment. What do you see that those investors are not seeing? What would you tell them and how would you dispel that myth?
First off, I don't know if it's truly a myth. So I'd say that because, we're based here in Southern California, so we deal with this on a daily basis. We've also expanded to investing in Texas. Part of that is because as us wanting to grow our business, we want to focus on is being in markets where the demand is strong, right? And I think if you go into markets, I've said it before, if you're acquiring assets in markets where there's strong demand, that gives you a fighting chance to win. There's opportunity because of that, because we have, vacancy rates that are much lower than other parts of the country. And so our volatility isn't as bad, if that makes any sense. Like, I'll give you an example. A deal just traded in Irvine, big Class A apartment building for a 4 cap, all cash. I think it's like a $170 million deal or something like that. And so, you still see record, very high pricing. And so if you have a longer term outlook, it can be fine. And funny enough, Paul, there's a lot of investors who sold in California in 2020, 2021, traded into deals using floating rate debt in some of those Sunbelt markets that I would tell you from having friends with some of them regret it.
Let me ask you a question on the from an LP perspective. Again, we're individual investors. We're not institutional investors, right? And if you look at the options that are available to us to invest, it's the Smile States, it's the Sunbelt, all of those. And then, I've never seen a deal available, or very few, in California or New York or Pennsylvania, on the coast. So why is that? Why aren't these deals available to regular LP investors? All of the operators we deal with are in the, the growth states.
It's probably because the ways to make money in those deals don't necessarily align with the interests of those operators. And what I mean by that is those deals, I think, function, I've studied the Midwest markets. And they, a California deal is one where it's like, you can make great profits. It's going to take you a while because you can't really increase rents. Some places you can't do the heavy value add. You have incredible competition for deals. It can be harder because, there's anti-displacement laws. There's, we have statewide rent control, right? But the misnomer in statewide rent control, our statewide rent control is 5% plus CPI. So it's not crazy, but, you have we're a very tenant-friendly state. And so because of that, it necessitates taking a longer term outlook. And where it's hey, you can buy in Dallas, the job growth numbers are through the roof. We can pay $150,000 a door. We can dramatically increase rents. There's no tenant displacement laws. There's no rent regulations or any of this. And we can get in and out in 24 to 36 months. I think people are attracted to that. I don't think it's necessarily going to happen. Obviously, it's not happening now from those 2021 and 2022 vintage deals. But I think in California, the way to make money is you've got to buy it and hold it, usually on a longer term basis. That's not as sexy for an investor sometimes. It's also not as sexy for the operator who's trying to get to a promote, right?
Because institutions are more patient than me, the LP, where I want to turn it right away.
The other thing we have in California is we have a lot of high net worth individuals who will buy apartments. So for instance, that deal I mentioned, that was a high net worth family who's buying that apartment. So we tend to have people who can write significant checks to buy apartments locally. And we have the Irvine Company here in Orange County. Chairman Don Bren's the richest real estate person in the world. He owns, I don't even know how many units in California, 60,000, 70,000. So we have these wealthy families and individuals who also, that's a uniqueness you don't necessarily see in a market like Phoenix, where you have local families here in California that will buy up properties and just hold them long term.
And then you mentioned the tenant displacement, right? That's one thing. The other thing was the rent control, which you kind of dispelled. But, you hear stories of, well, if you invest in California, someone will stop paying rent and you can't evict them for a year or two. Like, how do you get around that as an institutional investor?
After COVID, that was exactly right. And specifically in LA County, where we have projects, they just lifted those moratorium like a year ago, right? Well past when COVID was over, and the courts are still backed up in cases. And I could give you horror stories of tenants who owed us $60,000, $70,000, $80,000 in rent. We're driving brand new BMWs. I mean, I have a story where one of our properties in Glendale, we had a tenant owed us $55,000, showed up in our management office. She asked our manager, hey, I'm going to Hawaii for 2 weeks. Will you watch my unit? She goes, you owe us $55,000 in back rent. She goes, oh, I'm not going to have to pay that. And so there's a lot of very smart people here who understand how to get around those laws. I would tell you, I think we've seen the consequences of those. Those are all now gone. There are some anti-tenant displacement laws that have been put into effect, but they're usually in very specific areas. It's certainly been a challenge and certainly something we've dealt with. We just defeated, for the third straight time, rent control, which would increase the amount of units that could be under rent control in the state of California. I think California, from being on the ground, look, California will never be a red state. Just the demographics don't play to that. But we are moving back towards the center a little bit more, right? You saw that with a number of different things that happened in this recent election. I think that will be helpful long term.
You touched on it a little bit, John, differences in investing inside of California and out. And now that you're investing in Texas, I'm curious about your specific strategy. What are you seeing as far as the differences between those two states as an investor? And what's your approach look like? How does it differ?
Where it's different is you have to be very mindful of new supply. So we've specifically acquired projects in the city of Dallas. And what's unique is when we tour a project in California, like we don't really do a lot of new supply studies or, oh, where's the new supply going to come? Because we're like, it's not going to come. I think we've got more units under management in the city of Pasadena than any other group. I would tell you have no idea how hard it is to build in the city of Pasadena. New supply is not something we worry about. Going to Texas, I think that's been the thing that's been so surprising is how quickly supply can get built in a market like that, and how you really have to look at what are you buying per unit? What does it compare to replacement costs? Are you going to pay a price that's going to drive, local competition? It's very easy to get projects entitled. That's probably one of the bigger nuances. The other is just frankly, you're going to have to underwrite higher vacancy. And when you manage those assets, like a market like Dallas, 8% vacancy is considered great. Where like in California, you would be like, we are failing as a firm if we had 8% vacancy somewhere. The last thing is tenants there can afford to buy a house. I get these leasing sheets from our asset management team that show where we were, what's going on at each property, and what I want to know, like if tenants were moving out, why were they moving out? In California, it's rare where you see somebody, we moved out to buy a house. You're like, it's so expensive to buy homes out here that you don't see that. In Texas, you'll see that like 3 or 4 times a month, somebody says that. And so you've got to be aware of what's going on in the single family or rental and for sale markets because people can move out. California, in some ways, you have to be more active because of all the rent regulation laws and all this. Some ways you can be a little bit lazier because you don't have to worry about all these other factors, right? In a market like Texas, it feels like you have to play defense a lot more, and you have to really be aware of where you're building. You have to really be aware of your price per unit. You have to be really smart because it's so easy to build in those markets, and so much capital wants to be in those markets. And so we do a lot of things on the rent restricted side using property tax exemptions to try to be smarter and create more unique type properties, because to be in the market rate side in those markets, it's just you have to be really smart because your teams are going to be playing defense a lot more, if that makes sense.
And are those strategies you talked about, are those the affordable or workforce housing? And if so, can you talk a little bit about that? And what's the difference between affordable housing and workforce housing, if any?
We've been in the affordable housing development business using something called tax credits, low-income tax credits for many years, business that's been around since the 1986 Tax Reform Act, where it allows you to use tax credits to build affordable housing. True. And I would call affordable housing people who make 60% of the area median income or less. So these are low or very low income people. So we've built, probably 700 units. We probably have another 800 to 900 in pre-development right now in California. It's a great business. We don't need outside equity for that. And it's a great business for us and obviously very well needed. We have got into the workforce housing investment business. And what I mean by workforce, because it gets thrown around in a lot of ways, I mean rent restricted projects that generally use a public-private partnership model, which is usually a property tax exemption, where you are deed restricting anywhere from half to all of your units to people who make between 61 and usually 120% of the average median income. We would call this the missing middle. These are teachers, firefighters, nurses, people who are overwhelmingly saying they're being rent burdened. They're paying more and more of their income towards rent, and they provide vital services to areas, right? There's been a number of new programs, and I would say this is a trend across the United States, because as we've been undersupplied in housing, what a lot of politicians, both red and blue, have heard from constituents is the rents are too damn high, right? And so I think you're seeing this trend of these public-private partnerships pop up all over the place. Blue states, red states. By the way, look at us. We've done them in California and Texas, two very different political landscapes, but two landscapes where people are saying that rents are too high. And so we've leaned into this strategy. We really believe that over the next 10 to 15 years, that this will become a strategy that will gain more institutional acceptance. It'll gain more acceptance from a local government perspective. And this could be what I would call the new student housing wave, where if you remember student housing back in 2008, before the GFC, student housing wasn't institutionalized. After the GFC, people said, wow, these properties really performed well. And now student housing is its own niche. And I joke, Blackstone's in it, right? Heavily in it. And there's student housing conferences, and there's very institutional groups that do that. We see middle income and workforce housing very similar to that. So specifically in Dallas, we work with the Dallas Housing Finance Corporation. We can acquire an existing multifamily project. We go through a very rigid public benefit threshold test where we work with consultants that the HFC board hires to structure a deal where we can acquire existing market rate housing. We'll get a property tax exemption through a long-term ground lease. So the city will own the land, do a 99-year ground lease. Ultimately, the city of Dallas will own the land. We'll pay a ground lease payment, and then we'll rent restrict the units and try to, create a project that meets the public benefit test to have the city go, okay, this makes sense from the city perspective. Where it makes sense from an investment perspective is these are projects where you can acquire an existing deal. You can obviously lower your operating expenses because you're getting rid of the variable cost of property taxes, which in Texas is very volatile, and a huge percentage of your OpEx. You can rent restrict the project, so you're going to lose income, but the property taxes can help overcome that. And then you're also going to be able to get better debt from the agencies, Fannie and Freddie, because they want to put out at least half their debt in what they would call mission-driven strategies. So they'll take off 30 to 40 basis points of spread. And so when you look at it, it's great ways to create more, I would call it positive leverage. You can get better cash flow. You lose your upside in some ways because you're rent restricting units. So you're not going to, if Dallas rents ran again, like they did in 2019 through 2022, you won't be able to get all that benefit because you're rent restricting units, but you have more downside protection. And so we think in this environment, it makes sense both for retail and institutional investors. And so it's a strategy we're pursuing. And again, we think this trend of cities and local municipalities and groups trying to figure out ways to create more affordable housing, especially for this sort of missing middle, is going to be something that it's already increasing. Florida's passed laws that give you development bonuses if you build these type of units and tax credit breaks. South Carolina has laws that are in place, state of Washington. So I think you're going to continue to see this migration of these type of projects happen. Even if rents are flat or down, if you look at a market like Dallas, where rents are compared to where they were in 2018, they're massively up. And so if you're somebody on a fixed income, if you're a nurse, you probably haven't seen your wages rise with that. And so now the irony is a market like Dallas isn't as cheap as it once was.
You mentioned structuring debt, John, and just in general, let's touch on capital markets for a minute. Today, the 10-year sits at about 4.75, 4.8%, moving in the opposite direction inversely to the federal funds rate. How are you structuring debt or just the capital stack in general today with sort of the uncertainty and the weirdness that's happening?
It's hard, right? Because if you're looking at new projects, we've been active on the development side too, and it's just so hard to peg debt and where debt's going to be and where cap rates are going to be. I think we're really mindful of trying to pursue strategies where we have positive leverage, which is hard in this environment. Because again, cap rates haven't gone up. They've gone up some, but you're still seeing deals in, certain markets trade at low fives, high four cap rates. And that's more because equity has this long-term belief that prices and rents will rise as new supply comes down. And so I don't have a good answer for you, Paul, because it's really hard. This is one of the reasons why the market's not flush right now, right? And I've even seen some stats lately where it feels like bridge debt, because SOFR's come down, is almost as attractive again or becoming more attractive again. So it's really hard. We've always been trying to be a firm that plays the long game. We've done bridge debt in the past, but we always try to be mindful of it. And we're always trying to do things where we joked, in 2021, we were trying to do as much long-term fixed rate financing as we could. And, there were people out there who were saying that was dumb and you wanted to be, fixed rate debt is for suckers. I remember somebody said, and I'm like, I don't necessarily think that way, but it's hard right now to structure deals. And you're probably going to have to, in many ways, believe in negative leverage, which is tough. I don't know. Look, we were in the same boat as everybody else. After Labor Day, we thought Federal Reserve was cutting rates. You saw 10-year drop to 3.6. We said, okay, that's where I was really like, okay, I think 2025 is going to be a much better year. And here we are, 4 months later, and now they're at 4.75. It's just crazy.
Just curious on your outlook. Let's say a property is acquired today. It's a 5-year hold. What should the expectations be from the LP that are realistic, obviously, on return metrics? IRR, equity multiple, cash on cash, et cetera, generally speaking.
I think if you're buying multifamily, and you're buying properties, I would think you're going to get to a 20 IRR over the next 5 years because you're going to see massive rent growth, you're going to see cap rate compression. I think those days are over. I think you want to think about this stuff much more conservatively. And I think you want to be thinking about this probably in the low teens basis, where you're going to get it on an IRR. I think you want to be really mindful of what your stabilized yield's going to be in those type of deals. I think you want to try to invest in deals where you feel like you're buying at a good basis. What I always say is you want to look at, did the operator put a replacement cost analysis in their book? And is that placement cost analysis good? Because think about it. If you buy for under what it costs to replace, that's going to help suppress new development. And so if you feel like you're buying below replacement costs, so I would always consider that's probably a good basis. If you're hitting, if the operator is showing low to kind of maybe mid-teens IRRs, and you feel like it's an appropriate cap rate, and you want to invest, and you're going to get a decent amount of cash flow or a decent amount of return from cash flow, I don't think it's a bad to buy multifamily, because look, we are going to see a new supply cliff. New supply, it's very hard to pencil. So we're going to go into this period where, in 2026, you're going to see very limited starts. So we're going to go into a period 2026 through 2028. I think in a lot of these Sunbelt markets, you won't see the new supply numbers that you've been seeing. Provided the economy doesn't go into recession, we still see strong absorption. A lot of that new product will get absorbed. So it could be a great market, but you want to just be conservative and realistic. And again, you want to try to find operators that are aligned with you, that are buying because they're trying to be conservative and realistic. And I think that's really important.
Did I hear yield on cost? I thought I heard that.
Yeah, yield on cost. I mean, look, you want to try to be a yield on cost. What I tell my students is you always want to look at treasury rates, because that's your risk-free premium. Because if you buy a 10-year treasury at 4.75 today, federal government doesn't pay you that interest and that money back. We're all moving to islands because if there's a zombie apocalypse, and we shouldn't worry about anything. So you always want to look at that. That's your risk-free basis. And if you're doing a 5-year hold, probably look at the 5-year, which I think is 4.55. So look at that. And you want to look at a yield that's above that, because real estate has risk to it, right? It doesn't always work. And so you want to try to find a spread above that. And so you probably want your yield on cost. That kind of depends on you. But I would say you want at least probably 250 to 300 basis points above that, right, to justify going into something. And yeah, maybe you're buying in now because you believe that there's future rent growth, which isn't bad. I just think right now you want to be, I think, conservative, right? You don't want to be doing these risky things. And I think you want to be mindful of basis. You want to be mindful of location. But, long term, if you're smart, multifamily I think it's going to go back to the business it was, which was kind of a boring business, right? You might have less viewers and listeners, but candidly, I think we could all do well and fine. And it's a business that should be a little bit more boring. And you should be looking more that long-term kind of outlook on it if you're buying existing apartment assets. And so that's kind of where I would think the market is right now.
Well, for those that are listening, our listeners, where can they find out more about you, John?
Go to our website, waterfordco.com. There's a link on there where you can sign up if you ever wanted to see our deals. We've talked about in the past, trying to attract more private high net worth accredited investors. Just hasn't, been a business we've, built out or have done. I think that could change in the past, but certainly our website, waterfordco.com. They can obviously find me on LinkedIn too. I tend to post. I tend to be a little bit verbose, probably like I've been on this podcast, but you can find me on LinkedIn. And we always are interested in new investors. And I think our sort of track record speaks for itself.
Well, that's how we connected. Yeah, your LinkedIn commentary is fantastic. So if anything, for the listeners out there, please connect with John on LinkedIn. His commentary is very relevant, current, and insightful.
I appreciate that.
And thank you, John, so much for coming on the show. This has been a fantastic episode. We appreciate your insights, and we'll be hopefully talking again.
Sounds great. And again, I really appreciate the opportunity to speak with you today.
That's it for this episode of Passive Pockets, brought to you by Equity Trust. We want to thank John Dr. Doom Drachman for sharing his market outlook and advice on navigating multifamily in these uncertain times. If you enjoyed this episode, don't forget to like, subscribe, and share your thoughts or questions in the comments. Also take our survey at passivepockets.com/survey. For more resources on passive investing, visit our website, passivepockets.com, and join our community with a 7-day free trial.
We're launching an important new feature on the Passive Pockets website, an all-new sponsor review tool. This new tool allows Passive Pockets members to vet sponsors so you know who to invest in. Community is your best asset, so head to passivepockets.com and check out our new sponsor review tool today.
Thanks for tuning in, and as always, happy investing.